All right, on to your money. Investors are hoping for another strong week, particularly in light of a debt deal worked out for the nation of Cyprus. The market has been way up for the past month, breaking all kinds of records, the Dow at least. But we're in for a correction, so says investment expert Lance Roberts, who hosts Street Talk Live on KSEV radio starting at 6. Lance?
Yes.
Every time it looks like the market can't go up any higher,
it goes up higher.
It does.
Yeah.
I mean, it is like on steroids.
Yeah. That's a good way to put it, too. I mean, if you look at what we've got going on, we have the Fed that's pushing in $85 billion a month by buying bonds. That liquidity has to go somewhere. And that is what's called the Bernanke put, so to speak, because it provides a floor underneath the markets. And, of course, this allows hedge funds, mutual funds, investors to jump in and keep driving prices higher. And that's fine. There's absolutely nothing wrong with that. But the important thing here is and we talk a lot about stretching a rubber band as far as you can. And if we look at all different measures of irrational exuberance, so to speak, you know, bullishness and all these type of things, they're stretched as far as they can go. Now, it will not last forever, and that's my point here, is that as an investor, as somebody who's got money at risk in the market, you know, there are times that we want to take some profits. And, you know, the old adage is to sell high and buy low. Well, if you don't sell high, you can't buy low. And that's the point, is that we're very extended, and something like this deal in Cyprus, which we can talk about, but there are other ramifications that are coming that could very well trip up this market. So be a little bit cautious here.
Well, since you mentioned it, let's talk about the Cyprus thing, because, okay, so Cyprus is this little island that's sort of been battled over between Greece and Turkey for eons. But I never knew this, but apparently it's a banking haven for big money that comes from maybe some unsavory sources.
Yeah, Russians. So, yeah.
But the mob.
Yes, it is, and it is an offshore haven for a lot of the money that occurs through the actions that happen in Russia. And we hear about this a lot from you know selling people and all kinds of stuff. So there's some very bad people that are involved with this money. And now here's the interesting thing on this bailout, is that Laiki Bank, which is the second largest bank in Cyprus, they were completely wiped out on this deal. Depositors will lose 100% of their money in some cases. Bondholders are going to get completely converted into equity in Cyprus Bank, which is the main bank. And so there's going to be some real damage here done to depositors. And this was to secure that $13 billion loan. But the question that nobody's asking is why didn't they just allow Cyprus to default on their bond? The reason is that the majority of the Cyprus bonds are held by the ECB, the European Central Bank, as collateral for other loans. If those bonds are allowed to default, it wipes out the capital of the European Central Bank. That's why all this has occurred. This hasn't put a dent in our stock market, really, at least not yet. Now, we just talked about the Dow reaching its all-time high, which is a little confusing because the components that make up the Dow 30 have changed since 4 or 5 years ago. But overall, would you say investors have recouped their losses since before the financial crisis? No. I think I know the answer. The answer is no. And see, here's the problem, is that if I'm invested in an index, let's say you and I are equal investors. You buy all 500 stocks in the S&P 500 index, and I just own the index. Well, when GM goes bankrupt, you actually have a hard dollar loss in your portfolio. As an index, all I do is take GM out and I stick another stock in, and because I'm market capitalization weighted, which is simply the price of the stock by the number of shares outstanding, there's no real dollar loss here. It just readjusts the index. That's why investors can never beat the S&P 500 index over time, because of this is called the substitution effect. You can't do it. You suffer real hard dollar losses. I don't. And so that's the problem here, is that most investors, because of emotional mistakes, in other words, buying high and selling low, and doing everything exactly the opposite of what they should do emotionally within investing, they have not recovered. I have a feeling that it seems like when the market crash happened and we hit our bottom, that a lot of investors, especially those of you that may be like in your 50s or 60s, completely bailed out of stocks. I know, like my mom is, for example, one, or she just sold at the bottom and was scared to ever get back in. And now that we've recovered all this way, now they're kicking themselves and saying, man, I should have been in there the whole time. Let me just get back in. Exactly. And what did we just say a minute ago about buying high and selling low? This is that emotional pull. This is emotional drag, which drags people in, and they're going to wind up making a very big mistake by buying here. Not if they listen to you. But let me just ask you this finally. Because in your X Factor report that you issued this weekend, and go to streettalklive.com to download it, because it's required reading every week. If we do get a pullback, let's say it drops 10% and there's some big panic, is that a time to buy back in, or is it a time to run for the hills? It will That will depend, and as long as we get a correction, right now we could suffer a 10 to 15% correction, and we could actually still be in a buying. In a place to buy.
Right.
A larger correction, something that begins to break this upward trend that we've had over the last 3 years, like we saw in 2007, 2008. Something that tells us that we have ended this particular cycle will be much different, and we won't know that until it begins to occur.
All right.
But for right now, yes, you know, as an investor and as a money manager, what I do is I'm just looking for good corrections of 5 to 10 to 15% so I can be buying.
Get back in.
I just don't want to. I don't want to buy here at the top. I'm holding what I have. I'm looking for opportunities to buy cheaper.
Good deal. All right. Well, we'll have to have you back on to talk about it when and if that ever happens.
Absolutely.
Melissa.